Pi Network has become a hot topic in the cryptocurrency world, capturing the attention of both seasoned investors and newcomers alike. This is largely thanks to its innovative approach to mobile mining, which allows users to earn Pi coins directly from their smartphones, and its already massive and rapidly growing user base. The ease of access and the promise of future value have fueled its popularity. While the official Pi coin isn't tradable on major exchanges just yet, as the mainnet launch is still pending, IOUs, and derivatives representing claims on future Pi coins have emerged, sparking a highly speculative market. These instruments allow traders to bet on the future price of Pi before it's even officially available. Recently, the Pi IOUs and derivatives have shown periods of sharp volatility, characterized by rapid price swings and unpredictable movements. This volatility reflects the uncertainty and excitement surrounding the project. This has led to traders closely eyeing key price levels, carefully analyzing charts and indicators in anticipation of the mainnet launch. The launch is a pivotal moment that could significantly impact the value of Pi. After a period of price consolidation, where the price traded within a relatively narrow range, the price surged upwards, indicating renewed buying interest. This surge propelled the price towards a major resistance level near 70 cents, a price point where selling pressure was expected to increase. Excitement built within the trading community as the price approached and tested this ceiling, with many wondering if it would break through. However, strong selling pressure emerged at that level, leading to a swift rejection of the price and a subsequent downward move. This event provides a textbook example of how technical analysis can play out in real time within the cryptocurrency market. In this analysis, we'll break down the key factors behind why the Pi derivative was rejected at the 70 cents level. We'll explore what this rejection reveals about the underlying market dynamics, including the balance of supply and demand. Understanding the concept of resistance and the characteristics of the current bear channel pattern will give us a clearer picture of the forces at play in the Pi market. Our primary goal is to provide actionable insights for anyone closely watching Pi's price movements and considering potential trading strategies. By carefully analyzing the chart patterns, volume, and other technical indicators, we'll uncover what these patterns potentially mean for both buyers and sellers of Pi derivatives, helping you make more informed decisions. It's important to remember that this is purely an educational look at market mechanics and should not be considered financial advice. Trading involves risk. By the end of this analysis, you'll have a better understanding of why the price moved as it did in this particular instance, and crucially, what key factors to watch as Pi Network continues its journey towards the highly anticipated mainnet launch. In trading, understanding key price levels is paramount. These levels often act as significant turning points or areas of consolidation. One such level is resistance, which acts as a price ceiling, preventing the price from easily moving higher. It's a zone where upward momentum often stalls. This happens because resistance is where sellers consistently overpower buyers, stepping in to prevent further price increases. The supply outweighs the demand at this level. When we look at Pi derivatives, a similar pattern emerges. Specifically, 70 cents has become a formidable barrier, a level that Pi has struggled to overcome. This price point has been tested and rejected multiple times, indicating strong selling pressure whenever the price approaches it. Each approach to this level acts as a test of the market's resolve, and each test triggers a wave of sell orders, as traders anticipate the price will bounce back down. This repeated selling pressure reinforces its status as a strong resistance zone, making it increasingly difficult for buyers to push the price higher. The more often resistance holds, the more validated it becomes in the eyes of the market. Consequently, the more traders expect a reversal at that level, anticipating that the price will fall back down after hitting resistance. This expectation then contributes to creating a self-fulfilling prophecy where the collective actions of traders reinforce the resistance level. Therefore, smart traders grow cautious as price nears resistance, recognizing the increased likelihood of a reversal. They are often waiting for a confirmed breakout above the resistance level, signaling a potential shift in market dynamics. Alternatively, some traders might consider short positions, betting that the price will be rejected at resistance and move lower. In the case of Pi, the 70-cent wall is a psychological battleground, a key level that both buyers and sellers are closely watching. For the price to break through, buyers must absorb heavy selling, demonstrating significant buying power and conviction. A decisive move above 70 cents would be a significant event, suggesting a potential change in the prevailing trend. This is especially true on high volume, as increased trading activity would further validate the breakout. Such a breakout would signal a shift in sentiment, indicating that buyers are now in control and that further price increases may be likely. Until then, this level defines the upper boundary of PI's current trading range, acting as a ceiling that the price has yet to convincingly break. Therefore, understanding and respecting resistance is crucial for risk management, helping traders to make informed decisions about when to buy or sell. For now, 70 cents remains the line in the sand for PI, a critical level that will likely continue to influence its price action in the near future. The recent PI derivative rally towards 70 cents was a classic failed breakout. Bullish momentum and higher lows fueled optimism, but as price hit resistance, sellers stepped in. A brief push above 70 cents lured in eager buyers, a classic fakeout. Sellers quickly overwhelmed demand, triggering a sharp reversal. The chart showed a bearish candlestick with a long upper wick, signaling exhaustion from buyers. Several red candles followed, confirming sellers' control. Each failed attempt at resistance adds to its strength, as trapped buyers look to exit on future rallies. For now, the bears have defended 70 cents, and the market searches for new support. This rejection reinforces the importance of technical levels. The battle for 70 cents is over. For now, sellers have won. Let's visualize the 70-cent rejection on the chart. We're going to break down exactly what happened when the price attempted to push through this key level and failed. Understanding these visual cues is crucial for any trader looking to make informed decisions. Drawing a horizontal line at 70 cents highlights its historical significance. It's not just an arbitrary number. This level has acted as a ceiling for price action in the past, a point where buying pressure weakens and selling pressure takes over. Multiple failed breakouts are clear. Each attempt to breach this level was met with strong resistance, indicating a significant barrier for the price to overcome. This pattern of rejection builds a narrative of market sentiment. Zooming in, you'll see a strong green candle up to resistance, a bullish signal suggesting buyers were attempting to drive the price higher. This initial surge often creates a sense of optimism among traders, followed by a rejection candle with a long upper wick, a telltale sign of selling pressure overpowering the buyers. The long wick indicates that the price was pushed back down from its high, a clear bearish signal, a classic bearish reversal. This pattern suggests that the upward momentum has stalled and a downward trend is likely to follow. Recognizing this pattern early can help traders avoid potential losses. Red candles after the rejection confirm strong selling pressure. This reinforces the bearish sentiment and indicates that sellers are in control of the market. The size and frequency of these red candles can further gauge the strength of the downtrend. Overlaying volume, you'll notice spikes during both the rally, indicating significant buying interest as the price approached the resistance level. This surge in volume often accompanies breakout attempts. And the rejection, highlighting the intensity of the battle between buyers and sellers at this critical price point. The increased volume during the rejection suggests that many traders were selling off their positions, confirming heavy participation. This high level of activity validates the significance of the 70-cent level as a key area of interest for traders. This visual evidence helps traders map out key levels, identifying areas where the price is likely to find support or encounter resistance. These levels serve as potential turning points in the market. 70 cents as resistance, acting as a ceiling that the price has struggled to break through, and support zones below. These zones represent areas where buying pressure is likely to emerge, potentially halting further price declines. Marking these lines creates a roadmap for entry, providing clear signals for when to initiate a trade based on price action around these key levels. Exit and risk management. This allows traders to define their profit targets and set stop-loss orders to protect their capital. The chart tells a story of repeated rejection, highlighting the strength of the resistance level and the challenges buyers face in overcoming it, and market psychology at play. Fear and greed drive these patterns, influencing buying and selling decisions. Recognizing these patterns is essential for planning trades. It allows traders to anticipate potential price movements and adjust their strategies accordingly. The 70-cent line remains the critical level to watch. A successful break above this level could signal a significant bullish move. Support below will be tested next. If the price fails to hold at these support levels, further declines are possible. Chart analysis turns past price action into future strategy. By understanding the historical context and identifying key levels, traders can develop informed trading plans and manage their risk effectively. Beyond resistance, the broader structure for PI is a bear channel, a downward sloping range between two parallel lines. The upper line connects lower highs, dynamic resistance. The lower line connects lower lows, dynamic support. Price oscillates between these lines, trending down overall. Each rally fails to break the previous high, showing persistent selling. Each sell-off breaks the previous low, confirming bearish momentum. The recent 70-cent rejection likely coincided with the upper boundary of this channel, creating a powerful confluence of resistance. Trading in a bear channel favors shorting near the top and caution near the bottom. Buying at the lower boundary is risky and counter-trend. The downtrend remains until price breaks decisively above the upper channel line. For now, the path of least resistance is down. The bear channel's mechanics reflect trader psychology. The upper trend line is where sellers take profits and short sellers enter, creating a ceiling. The lower trend line attracts bargain hunters and short covering, providing temporary support. Price bounces between these boundaries in a tug-of-war, but the overall trend is down. The median line inside the channel can act as minor support or resistance. For PI, the 70-cent rejection happened at both the upper channel and horizontal resistance, a double barrier. This confluence led to a strong sell-off, sending price back toward the channel's lower end. The next key test: will buyers step in at the lower boundary, or will bears push price even lower? Watching these levels helps traders anticipate the next move. The channel remains the dominant structure until a breakout occurs. The bear channel and recent rejections signal a bearish market for PI derivatives. Caution is key. Buying aggressively in a downtrend is risky. Bullish traders should wait for a confirmed breakout above both the channel and 70-cent resistance before acting. Patience pays off in bearish climates. For bears, shorting near the upper channel with stops above resistance is a textbook strategy. Profit targets are set near the lower channel boundary. Even bears must watch for reversal signals. News and fundamentals matter. A major Pi network announcement could trigger a sudden breakout, overriding technicals. Stay alert to both chart patterns and project updates. Technicals guide the short term, but fundamentals can change the game. Adapt your strategy as conditions evolve. Traders should focus on the bear channel's boundaries. The upper trend line and 70-cent resistance are the main upside levels. Watch for high volume breakouts. Another rejection here likely means a move toward the lower channel. The lower trend line is key support. A bounce could offer a short-term trade, but a breakdown signals further downside. Volume is crucial. Big moves need strong volume for confirmation. Low volume breakouts are suspect. High volume moves are more reliable. Use technical indicators like RSI for extra confirmation: overbought at the top, oversold at the bottom. Combining price action volume and indicators gives a fuller picture. Don't rely on one tool alone. Stay nimble and adjust as the chart evolves. The 70-cent rejection was a textbook technical event, driven by strong resistance and the bear channel's upper boundary. Sellers are in control. The downtrend remains until bulls break out above key levels. Traders must identify and respect these patterns. They reflect real market psychology. The PI chart is a real-world lesson in technical analysis. Watch the channel boundaries for the next big move, a bounce or breakdown at support, or a breakout above resistance. The 70-cent wall is the hurdle for any bullish reversal. Ultimately, Pi Network's fundamentals, especially the open mainnet launch, could override all technicals. Combine chart analysis with project news for the best trading edge.